In 1788, a French finance minister handed King Louis XVI a document containing the kingdom's true financial position. The king read it, placed it in a locked drawer, and ordered that no copy be made available to the public. 3 years later, the monarchy ceased to exist. The document had revealed something the state could not afford to acknowledge. The system was already broken. The collapse wasn't caused by the revelation. It was caused by the years spent hiding it. Throughout history, there has always been a ledger, a true accounting, and it has almost never been shown to the people who depend on the system it describes. This is not a story about conspiracy, it's a story about structure. About what happens when financial systems become too complex to fail visibly, too important to question publicly, and too broken to fix quietly. Every major currency collapse in recorded history shares a common feature. The system appeared stable until suddenly it did not. The Roman denarius held its value for over 2 centuries. Citizens trusted it. Merchants used it across 3 continents. Soldiers fought for it. Then, across a span of 50 years, emperors began reducing the silver content from 95% to less than 5%. The coin still looked the same. It still bore the emperor's face. Markets still accepted it, but the ledger had changed. The real value was draining away while the appearance of legitimacy remained intact. The public did not have access to the imperial mint's records. They could not see the ratio of silver to base metal. They could not audit the treasury's reserves. They knew only what they were told. The currency was sound, the empire strong, the system eternal. Confidence is the invisible foundation of every monetary system. It is not backed by law or force alone. It is backed by belief, and belief requires a controlled narrative. When a system is young, this poses little danger. The ledger is simple. The promises are modest. The gap between what is owed and what exists remains manageable. But as the system matures, the promises multiply. Obligations grow. The ledger becomes inconvenient. The modern architecture of global finance was not designed in a single moment. It was built in layers, across decades, by people solving immediate problems without full knowledge of the structure they were creating. In the 17th century, goldsmiths in London began issuing paper receipts for gold deposits. The receipts circulated as currency. They were easier to carry, easier to divide, easier to transact. The system worked because the receipts were redeemable. The ledger was balanced. Gold in the vault matched paper in circulation. But goldsmiths noticed something. Not everyone redeemed their receipts at once. Most of the gold sat untouched. So they began issuing more receipts than they had gold to back. This was not fraud initially, it was efficiency. The system functioned smoothly as long as confidence remained high and redemptions stayed low. This practice became fractional reserve banking. It allowed credit to expand beyond the physical constraints of metal. It financed trade, industry, exploration. It created liquidity where none had existed. And it introduced a gap, a permanent gap between promises and reserves. The ledger now contained 2 numbers, what was owed and what actually existed. For the system to survive, the second number had to remain hidden. By the 19th century, this model had spread across Europe and into the Americas. National currencies emerged, backed not by gold alone but by the perceived strength of the issuing government. Central banks formed to manage the gap, to smooth over moments when confidence wavered, to ensure that the ledger's 2 columns never came into direct comparison. The system worked. Economies grew. Credit expanded. Infrastructure was built on borrowed money that would be repaid by future prosperity. The gap widened, but so did the economy. As long as growth outpaced obligations, the imbalance remained theoretical. People trusted the system because it delivered results. Wages rose. Goods became abundant. The currency bought more each year, or at least appeared to. The ledger was a technical matter, best left to experts. Citizens did not ask to see it. They had no reason to doubt. The German Papiermark entered the First World War as a stable currency, backed by gold and the industrial might of Europe's strongest economy. By 1923, it had become worthless. The collapse is often attributed to reparations, to the Treaty of Versailles, to external pressure. These were factors, but they were not the primary cause. The true damage had been done earlier, during the war itself. When the German government chose to finance the conflict not through taxation but through borrowing and printing, the public was not informed of the scale. War bonds were sold as patriotic duty. The money supply expanded silently. The ledger diverged. Promises multiplied faster than the economy could sustain. When the war ended, the gap was irreversible. Reparations simply made it visible. The government continued printing to meet obligations it could not otherwise pay. Prices began rising. Slowly at first, then exponentially. What is often overlooked is the delay. The inflationary collapse of 1923 began with policy decisions made in 1914. For 9 years the system appeared to function. People adapted to higher prices. They blamed external enemies, profiteers, speculators. They did not blame the ledger because they could not see it. When confidence finally broke, it broke completely. Citizens began spending money the moment they received it, not because they were irrational but because holding currency overnight meant losing value by morning. The currency did not collapse because people panicked. People panicked because the currency collapsed. The ledger had already condemned it years earlier. In 1716, the French monarchy was bankrupt. Decades of war, extravagant spending, and a tax system that exempted the wealthy had drained the treasury. The currency was debased. Credit was frozen. The state was on the edge of insolvency. A Scottish financier named John Law proposed a solution, a national bank that would issue paper currency backed not by gold, but by the promise of future wealth. Specifically, the wealth expected to flow from France's territorial claims in the Mississippi River Valley of North America. The plan was approved. The bank was established. Shares in the Mississippi Company were sold to the public. The price soared. Fortunes were made. The currency stabilized. The system appeared to work. But the ledger told a different story. The wealth in the Mississippi Territory was speculative. The land was undeveloped. The profits were years away, if they materialized at all. The bank issued currency far in excess of any tangible backing. The gap was enormous from the beginning. For a brief period, belief sustained the system. As long as people believed in the future value, the present value held. But belief is not infinite. In 1720, a few informed investors began quietly selling their shares. Others noticed. The rush began. Within months, the currency collapsed. The bank failed, and the French economy plunged into chaos. The public had been told the system was sound. The ledger had never been disclosed. When the truth emerged, it was too late to adapt. The damage was structural, built into the system from its inception. In every case, the breaking point arrives, not when the ledger fails, but when people realize it has already failed. This is the crucial distinction. The collapse is not a sudden event. It is a delayed recognition. The system breaks quietly, internally, often years before the public becomes aware. By the time panic sets in, the outcome is already determined. Historians call this a loss of confidence. But confidence is not lost arbitrarily. It is lost when the gap between perception and reality becomes impossible to ignore, when the promises can no longer be met, when the ledger is finally exposed. The British pound held reserve currency status for over a century. It financed empires, underwrote global trade, served as the anchor for international transactions. Then came to world wars. Britain borrowed heavily, printed extensively, and made promises it could not keep. By 1944, the ledger was broken. By 1967, the pound was devalued. By 1976, the country required an emergency loan from the International Monetary Fund to avoid default. The decline took decades. The breaking point was silent. Most citizens did not realize the system had fundamentally changed until the consequences were unavoidable. The long-term damage from a currency collapse is not merely economic, it is institutional. When a currency fails, trust in the issuing authority fails with it. Citizens learned that the promises made were empty, that the experts were wrong or dishonest or powerless, that the system they relied upon was not designed to protect them. This lesson does not fade quickly, it passes through generations. In Germany, the hyperinflation of 1923 shaped monetary policy for a century. In Argentina, repeated currency crises created a permanent skepticism toward government-issued money. In Zimbabwe, after the collapse of 2008, citizens stopped using the national currency entirely, even after a new one was introduced. The fallout is not limited to economics. Political systems fracture, social contracts erode, institutions lose legitimacy. The gap that existed in the ledger spreads into other areas of governance. If the currency was a lie, what else was? Governments facing currency collapse follow predictable patterns. They deny the problem, blame external forces, impose controls, and eventually attempt to restore confidence through reform. These measures rarely address the underlying gap in the ledger. Price controls are common. If inflation is the visible symptom, then fixing prices appears logical. But prices are not the cause, they are the signal. Controlling them does not eliminate the gap. It distorts the information the market uses to allocate resources. Shortages follow. Currency redenomination is another frequent response. The old currency is replaced with a new one, often at a ratio of hundreds or thousands to one. This resets the nominal numbers but does not repair the structural imbalance. If the new currency is issued under the same framework as the old, the gap reappears. The most common fix is austerity, cutting spending, raising taxes, shrinking the gap by force. This addresses the ledger's imbalance, but it imposes immediate pain. Politically, it is often impossible to sustain. Governments fall. Policies reverse. The gap reopens. Throughout history, the fixes that succeed are those that fundamentally restructure the system. New currencies backed by tangible assets. Independent central banks insulated from political pressure. Debt defaults that clear the ledger entirely. These solutions are rare because they require admitting the previous system was broken, that the promises were false, that the ledger was a lie. The patterns do not disappear. They repeat with different variables, new names, updated technology, but the structure remains. In recent decades, a global system emerged, far more complex than any previous monetary architecture. Currencies are no longer backed by gold. They are backed by the full faith and credit of the issuing government. Credit itself has expanded beyond traditional boundaries. Derivatives, securitized debt, digital ledgers, obligations measured in the hundreds of trillions. The gap has never been larger, the promises have never been more abstract, and the true ledger has never been more hidden. Central banks now manage not just currency but entire economies. They set interest rates, purchase assets, provide liquidity during crises. Their balance sheets have expanded to unprecedented levels. In times of stress, they create money not by printing physical notes but by altering digital entries. The gap grows with each intervention, but the system continues to function. Why? Because confidence remains, because the alternatives appear worse, because most people do not see the ledger. The progression follows a consistent sequence across centuries. Phase 1. Innovation. A new system is introduced to solve a real problem. It works because it is modest, transparent, and the gap is small. Phase 2. Expansion. Success breeds trust. The system scales, promises multiply. The gap begins to widen, but growth masks the imbalance. Phase 3. Normalization. The gap is now structural, it is no longer questioned. Experts assure the public that this is how modern systems operate. Complexity is presented as sophistication. Phase 4. Hidden strain. Internally, the system shows stress. Central authorities take extraordinary measures to maintain stability. These measures are technical, opaque, not discussed in public forums. Phase 5. External shock, a war, a pandemic, a financial crisis. The shock is not the cause of collapse, but it accelerates the recognition. The gap, previously hidden, becomes harder to ignore. Phase 6. Loss of confidence. The public begins to question, not all at once, but in waves. First the informed, then the institutions, then the masses. Once begun, the process is difficult to reverse. Phase 7. Collapse or restructure. The system either breaks or is fundamentally redesigned. In both cases, promises are broken. The ledger is cleared, one way or another. We are taught to see each collapse as unique. Different causes, different contexts, different actors, but the structure is the same. The ledger diverges. Confidence sustains the illusion. Reality eventually intrudes. Human beings are not built to perceive slow-moving systemic risk. We react to immediate threats, fire, predators, violence. We are less equipped to respond to abstract dangers that unfold over years or decades. This is not irrationality. It is adaptation. For most of human history, long-term systemic threats did not exist. During the decline of a currency, this creates a predictable psychological pattern. Early warnings are dismissed as alarmist. The system has always worked before. Experts provide reassurance. Life continues as normal. As strain increases, people adapt rather than react. Prices rise, so they adjust their budgets. Savings lose value, so they shift into other assets. The system degrades incrementally, and each incremental step feels manageable. This is normalcy bias. The assumption that the future will resemble the past, that institutions are stable, that someone in authority is managing the situation. It is not stupidity. It is the default mode of human cognition. By the time the danger becomes undeniable, options have narrowed. The best moment to act was years earlier, when the threat was still abstract. But abstract threats do not trigger action. Concrete ones do. And by then, it is often too late to avoid the consequences. This is the period we occupy now. The phase after the gap has widened, but before confidence has broken. The ledger exists. The imbalances are measurable. Obligations exceed reserves by margins that would have been unthinkable a generation ago, yet the system functions. Markets operate, currencies exchange, debts are serviced. Why? Because belief persists, because alternatives remain unclear, because the complexity of the system makes it difficult to pinpoint exactly when or how it might fail. History suggests this is the most dangerous phase, not because collapse is imminent, but because the gap is largest when confidence is still high. The longer the imbalance persists, the more severe the eventual correction. The silent phase can last years, even decades. The Roman currency degraded over half a century. The British pound declined across 2 generations, but the direction, once established, is difficult to reverse without fundamental restructuring. And restructuring requires acknowledgement. It requires showing the public the ledger they have not been allowed to see. In 1797, the Bank of England suspended the convertibility of its notes into gold. The suspension was supposed to be temporary, a wartime measure. It lasted 24 years. During that time, the currency remained in use. The economy functioned, trade continued. Most citizens did not understand what had changed. The notes still bore the same designs, the same promises, but the ledger had shifted. The backing was gone. What remained was belief. When convertibility was finally restored in 1821, it was at great cost. Deflation, unemployment, social unrest. The gap had to be closed. Reality had to be reconciled with the promises made decades earlier. The people who made the decision to suspend convertibility in 1797 did not live to see the consequences in 1821. The gap was passed to the next generation. As it always is, there is always a ledger. It exists whether we see it or not. And history does not suggest that ignorance protects us from its conclusions. The question is not whether the ledger will balance. It always does, eventually. The question is how, and who will pay the cost.